So the first question really does come back to Tafara's presentation with regards to yield curve. So maybe like Tafara, we can possibly talk more about how what a yield curve is, why it's important, and why it acts as a signal towards periods of economic recessions, if you don't mind.
Sure, I'd love to go ahead and do that. So when it comes to yield curves, like I mentioned, they're a great indicator of recessions, and actually they are the most accurate indicator when it comes to recessions. So I'll give you some of the other measures, and then we can dive into yield curve specifically. Okay. So the top indicators for recessions are and this is specific to the US. These is the volatility index, or the VIX, and then GDP contraction. So two consecutive quarters with negative GDP growth. And then you also have low industrial outputs and sales. So that's your performance of like your industries, so your PMI and manufacturing numbers. And then you have unemployment rates. And then you have the inverted yield curve. Now, when it comes to the yield curve, like I mentioned, it's said to be inverted when the long-term interest rates drop below the short-term interest rates. Now, that signifies a number of investors are moving their money away from the short-term bonds into long-term bonds. And the inversion of any yield curve can suggest that the market is losing confidence in any economic prospects in the near future. So meaning your confidence is low in the government, right? So I'm not confident that the government will be able to pay me a yield on my bond. So the demand for that tenure goes down. Whereas I'm looking to hoard my money. I'm looking to just only invest it for a short duration. So that demand for that short end goes up, right?
Yes.
Yeah. So I like to think of it like personally, right? If I asked for a loan from you, Mal, and I said, can I have a loan for, 10,000 kwacha, and I'll give it back to you in 6 months, right? And you'll tell me, okay, I expect to top up a kambashela when you return the loan.
Yeah.
And so let's say you say, okay, give me an interest rate of 7% when you return it, right?
Yeah.
But if I ask for that same 10,000 kwacha and I say, but I can only pay you back in 2025, you'll probably want more of an interest rate, more of a percentage, right?
Yeah.
Because so many things can happen between now and 2025. I can run away, I can change my phone number, so the risk has to match the reward. It's the same thing when it comes to the government. So if investors lose confidence in the economy and the production of the economy on the long-term outlook, there's less demand for those long-term bonds. There's more demand for the short-term bonds because we know, okay, there's not really much that can change between now and December or between now and next year, January. So that demand on the short end increases.
Right. So in a normal kind of like period, like you were saying, the shorter term bonds, so like the 1 month, 2 month, 3 month, should have like a lower interest rate than the 10-year, 20-year, 30-year, just because 10-year, 20-year, 30-year, you're taking a longer time period. There's more risk, so you should expect to be paid more, right? And so that's just like in a normal environment.
Correct.
Is that correct? Yeah.
Yes.
And so what's happening here is that people are losing confidence in the long term. So 10, 20, 30 years, there's just like so much uncertainty that there's no demand for those anymore. And they'd rather just like place it in the shorter term bonds, which is why you have this inverted yield curve where the interest rates for the 1 month, 2 month, 3 month are actually higher than the 10-year, 20-year, 30-year. Is that correct?
Correct.
Okay. Yeah.
So that's why I mentioned. So when it comes to now recessions is when you see that perspective shift in investor sentiment, when you see it shift back to that norm where the demand for the short term is low and the demand for the long term is higher, then essentially the investor is feeling more confident, right? So
yes,
the recession
correct.
is over, right? So the recession is over because the investor is feeling more confident in that sentiment. Yeah.
That's like super helpful. I also use the yield curve just because it has been a very accurate predictor of economic recessions. Mm-hmm. And so once I see that invert, we should we should wait to embrace some pain.
Yes.